The buying process. So, all you first time buyers out there, tonight, we are going to be talking about the buying process. I'm going to run you through from beginning to end. It's all very well having a deposit strategy and having knowing how to build your credit, but unless you know the order of the buying process, the components of the buying process, it really does make a big difference because this is what holds it all together. So, this is what I'm going to be going through. So, who am I? My name's Manda, the mortgage coach, and I combine mortgage advice with financial coaching. So, let's get started with further ado. I am going to share my screen, and then that way you guys can actually see the diagram and we can actually work through it. So, um, let me get going and actually share my screen. Here we go. Right, so here is the buying process. When we're looking at the buying process, there are several different components. So let's start at the beginning. When we've got affordability, affordability is when you're working out what you can afford on a monthly basis. You also have borrowing, how much you can borrow, and that is more on the annual basis. But once you have that information, you can decide how much deposit you want to put in, and that all is matched up to your budget. Now, it's good to have a budget when you're saving up to become saving up your deposit to buy the property, but it's also just as important to have a budget after you've bought the property and you're running things month to month. So that's just something to be aware of. The next point is the decision in principle. That is the DIP. So with the DIP, you've got the DIP just here, and you can have a DIP, decision in principle, you can have an AIP, application in principle, or you can have an MIP, mortgage in principle, and they all mean roughly the same thing. I say roughly, they're not exact because different lenders have different criteria, and that's why they call them either a DIP, decision in principle, or the other two, because some will ask for more information than others. Some you can do with them very, very quickly. You just put what your income is, you put roughly what your expenses are, you may put in your name, and that's pretty much it. And then they will run a credit search in the background. They do their own internal credit scoring. That the majority of the time is a soft search, which means when you download your credit report, you will see at the bottom where it says inquiries, that lender has run an inquiry on you. But if any other lender runs a credit score on you, so for example, if they do an internal credit scoring after you've done the first one, they cannot see the second one because it is a soft search. The next thing is once you've done that decision in principle, a top tip I will always say when you're running it, either getting your mortgage advisor to do it or you doing it yourself, what I would say is do it on what you are budgeting for. The reason being, you lose your negotiation. So if you do it, and this is why a lot of estate agents will ask you to see their mortgage advisor because they want to know the maximum you can spend. So say you find a property for 250,000, but they know you can afford 300,000 and it needs a little bit of work. So you go in with an offer of say 240. So 10k less because you are negotiating, trying to get a bargain. You've done your research on Rightmove, Zoopla on the market, and you've seen that properties in the last 6 months in that area on that road have sold for a little bit less. So you're saying, one, it's not 100%, it's not a key term property. I'm going to have to do some work on it. Two, properties in that area with that spec haven't sold for as much, so I want to go in a bit lower. The estate agent knows that you can afford the asking price. So you kind of in a sticky situation there, you lose your negotiation. But if you have a decision in principle, a dip that says 240 and you go in at 240, as far as the estate agent's concerned, you're maxed out. So they'll talk to the seller and see what they can do for you, you know? Anyway, that's just my opinion. Other opinions are available. The next thing is types of mortgage. Now, this can kind of be split into a couple of categories here. You've got types of mortgage from the perspective of, is it fixed, i.e., it's going to be the same amount every single month? Is it variable with the interest rate go up and down? Is it tracker? Is it linked to the Bank of England rate? So those are certain types of more of mortgage rates rather than mortgage types. Then you've got mortgage schemes. Is it a joint borrower sole proprietor? Is it a bog standard first time buyer? Is it a right to buy? Is it um, a first time buyer scheme? What type of mortgage is it? Yeah. So is it shared ownership? Not so much right to buy, there's less and less now, but shared ownership, that kind of thing. Is it one of those mortgage schemes? And then what type of mortgage is it? Is it capital and repayment? Is it interest only? Now, interest only tends to be buy to let, capital and repayment tends to be residential, but then you've got part and part, which is a combination of the two. So the next thing is once you've done the property search, like I said before, you checked all those platforms and you've looked and you've negotiated, and then you've gone to see your mortgage advisor and you've talked through that you want a 2-year fixed capital and repayment. Then the next thing is to do the mortgage application. Now, some people call the mortgage application the app. Some people call it the FMA, which stands for full mortgage application. When you're doing that, you give all the information. So that includes employment history, how many dependents you've got, everything. It's a lot of information. So you fill all of that out and then you have to back it up with documentation. So if you're employed, then it normally is 3 months pay slips, and then they ask for bank statements. Now, if everything comes out of your current account and goes into your current account, then you just need to do those 3 months bank statements. So because what they want to do is they want to match your pay slip to the actual bank statement that's relevant for that month. If you're self-employed, they will be looking at how much income has been coming into your business account, or if you're a sole trader, the amount of money that's been coming into your current account, and then they'll add it up over the 3 months, times it up by, to pro rata it up to the year, and then compare it to your self-assessment. And if it matches roughly, then they're happy. If not, obviously they'll ask more questions. Then the other side of it is your expenses. They want to see all the expenses coming out of your bank account. So those are the documents they'll ask to see. They may ask to see, depending on whether you go direct with a mortgage advisor, they may ask to see proof of address and proof of ID. So all of that are the documents you need. Then the next stage is the survey. So with a survey, there are 3 types. So the first one is just a bog standard valuation. Now, they can do this several ways, and depending on your loan to value, so that is basically how much deposit you're putting down, they will assess how much of a risk they feel it is. If they don't think it's a big risk and you've opted for a valuation and they are paying for it, so it's free to you, they may not come and go and have a look at the property that you're purchasing. They may just go on a database and do a comparison, or sometimes they've done a drive-by just to check that your property that you're looking to purchase is in the rough same condition as other properties on the street that have sold for, similar amounts. So they may do that kind of sense check. But sometimes I've done a mortgage application and the valuations come back within an hour. So they obviously did a desktop valuation, which is where they just, check a database and do a comparison, as opposed to when they book an appointment and go round. So that is what a valuation is. The next one is called the home buyers. Now, the home buyers is the most popular for first time buyers, and it is very easy to understand because it's on a traffic light system. Each area that they look at, so it could be plumbing, it could be electrics, that kind of thing, they will actually assess it on a traffic light system. So if it's good and good to go, as I like to say, and everything is good, then it will be green. If they've got some minor faults, then it will be amber. And then if they've got some major faults, then it will be red. So based on that, that is kind of where you're coming from with it. So as I said, it is the most popular and it's one up from evaluation. Then the third one is a full structural. Me personally, every single property I've bought has been a full structural. It's a big, thick report. It goes into a lot of detail, but I've always wanted to know, as far as I'm concerned, any property I'm buying, especially as I'm London based, we're talking hundreds of thousands of pounds here. So why wouldn't I spend, that why wouldn't I spend more on a report in depth? The other thing is that reminds me with the valuation, sometimes it's a one pager, sometimes it's not even a report, sometimes it's just a tick to say, yes, it matches the value. So a lot of people say, oh, I'm going to go with a free valuation. That's saving me some money, which is great, but then just don't expect a report. So that's the next thing. Then after you've done the valuation, if they're happy, and they've done the survey and they're happy. All the information on the full mortgage application is happy. The people that review your mortgage application are called the underwriters. If they're happy and all the documents that you've supplied or the mortgage advisor has supplied, they're happy with all of that, then you should get your mortgage offer. Now, when you're looking at your mortgage offer, make sure that you check the details of the property that your personal details. It will also have yeah, it will also have information about your mortgage. So check if it is a fixed, check it's fixed. Check what rate you've agreed and what term it is, whether it's a 5 year term over 25 years or whatever you agreed when you initially did it. That information still needs to match. Even though it might have taken a couple of months to get to mortgage offer, you still expect to have the same rate that you did when the full mortgage application was done. So just double check that. The next thing is when you're looking at what your monthly payment's going to be. This is one of the questions first time buyers ask me all the time. The very first month's payment that it says is just an estimate because they don't know when in the month you're going to complete. So you never normally pay the mortgage till the month after completion, but it is a catch-all. So it will say you completed the third week of the month and then you pay the following month, you will be paying all of the following month plus that week that you completed of the prior month. And if you completed halfway through the month, then you'll have all of a month and then half of the other month, so roughly about 6 weeks. So when you look at that monthly payment, it normally is higher than what the normal monthly payment you've agreed is, but that's because it's combining when you completed in that current month plus the next month. I hope that makes sense. Any questions, please put it in the comments. I'll be more than happy to explain. The next thing is once you've got the mortgage offer, it's all about the solicitor. The reason why I don't tell people to instruct solicitors too early is because not all solicitors are on the lenders panels. So every single lender has a panel of solicitors that are allowed to do mortgages for that lender, for that bank, for that building society. But solicitors don't register with every single one. So what you don't want to happen, and this happened with one of my clients a couple of weeks ago, where they already booked the solicitor. In fact, it was the estate agent who told them, oh, yeah, use our solicitor. If you're not going to use our mortgage advisor, at least use our solicitor. So they registered with their solicitor, gave them money. They started doing the searches. So that's what they do. They do searches and then the information from the searches, they raise inquiries, which are questions. The searches, are basically land registry. When you buy a property, you have to register that you own it. So they run searches just to check that the person that is selling to you actually does own the property in the first place. I know that's a bit of a shock, but I've been in a situation where the person selling the property didn't even own it, but that's a whole nother story. But in these situations, the solicitor needs to do all of these searches and then raise inquiries. This all costs money. If you do all of this work, even though it is for that property and that's the property you're buying. If your solicitor isn't registered with that lender, you either need to get a whole new mortgage offer, which is quite a lot of work, or you need to get a whole new solicitor. What do you do? But if you wait till when you're doing the mortgage application and you know who the lender's going to be, then you can make inquiries to instruct the solicitor, but ask them not to do any searches or anything until you've got the mortgage offer. That's what I'd always suggest. Anyway, the next thing is exchange. Now, when it comes to exchange, a couple of things. One, you need building insurance from exchange. Two, exchange it's basically exchanging of the contracts. So there are two copies of the contracts. The buyer will sign one, the seller will sign one, then they'll swap, and then the one that the buyer hasn't signed, they'll sign that second one, and the one that the seller hasn't signed, they'll sign that second one. It's also when the deposit has to be handed over to your solicitor and they put it in their client account. Now, the last stage is completion. Now, it can be done on the same day as exchange, but normally we don't suggest that. It's normally a week later. And the way it works is on completion, what normally happens is the solicitor would have asked for the lender to drill down the rest of the money. So basically the mortgage balance. And that will get drilled down, and then on the day of completion it should be received first by the first time buyers solicitor, and then and then obviously with the client account money from the deposit, they put those together and they send it to the seller's solicitor. And then once the seller's solicitor confirms that they have all the money, that's when, the estate agent is told that they can release the keys if no one's living there, or, they work out how to give them access to the property on that day. So that is the day you get your keys, you move in, and it's all very exciting. But that is called completion. So this is the buying process. And as I've alluded to, as you go through, there are certain things that if you don't understand how it works or you do it out of order, there can be delays. I've seen mortgages then pull the mortgage offer because things weren't done in a certain order and things like that. There've been delays because, the solicitor didn't request the drill down from the lender, so the money didn't arrive in time for completion, and there's a lot going on. So if you know, as the person buying, the steps, then you can make sure everything is going as the way it is, rather than a lot of first time buyers. First, they're relying on the estate agent to tell them what they need to do. Then they're relying on the mortgage advisor to tell them what they need to do. Then they're relying on the solicitor. And then you could get contradictions and things like that. Once you know the process, it really does help. So I hope you've enjoyed this video. And remember to subscribe, and I look forward to seeing you soon.